Hello everyone, this is Terry with Futures.io, and as always I would like to thank you for joining us today. It is my pleasure to welcome Christopher Gray for today's webinar, Support Resistance and the Importance of Trading on Closed Data. If you have questions, please feel free to type them into the questions box throughout the webinar, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Chris, and you should get the pop-up to share your screen again. Okay, looking good. It's all yours, sir.
All right, thank you, Terry. Hello, everyone. My name is Chris. I am a trader and mentor here at Earn2Trade, and today we are going to be covering support and resistance and the importance of closed data. And the way I like to do things over at Earn2Trade, and I want to thank Futures.io for having us over here. But the way I like to do things is I like to keep things casual. I feel that it tends to be the most conducive for a strong learning environment when we just have a casual time. So what I'm going to bring to you guys today is a presentation on some of the most core aspects of technical analysis and price action surrounding support and resistance trading. We're going to look at some methods that I use personally, as well as some of us over at Earn2Trade, as well as many traders that I'm sure that you guys all know and trade with in your own experience as well. I'm going to show some examples from some live charts, as well as going back throughout the charts today. And just to keep it with that authentic feeling, I just want to be clear that at this point in time, I am going to be finding, when we do go back through the charts, I'm going to be finding our points of support, resistance, and areas where we hypothetically might have made a profitable trade for the first time in terms of looking at the charts, to try to keep it as real as it might be for when you're out there finding these areas on your own. But without further ado, we're going to go ahead and jump on in here to our PowerPoint, just get some points across the board on what we're talking about, and then we're, like I said, going to get into the more juicy material where we have this charts on screen, and I get to illustrate for you guys kind of like a Van Gogh, if you will, and my drawing skills are terrible, so I will put that disclaimer out there now. But buy the book, folks, as we get jumping on into it. So we know that support is an area where price can be expected to pause during a downtrend due to a concentration of demand. And as the price drops, demand increases, thus forming the support area. And price is expected to go from falling to rising. That's the easiest way we could sum up support. Then resistance, obviously going to be the exact opposite. Resistance areas can be thought of as an area that is formed due to a sell-off when price increases. Price is expected to go from rising to falling. These levels are best represented as an area versus an exact price number, and that's something that we're going to talk about as we get a little bit more into the more exciting portion of the webinar. We're going to talk about why I feel that price support and resistance in and of itself should be viewed as an area versus an exact number, and that's a common issue that I find newer traders tend to run into when they are identifying proper support and resistance areas. They tend to do it more so to an exact number, to the tick, to the point, to exactly a specific number. And if price doesn't reach that number to the T, they don't view it as a support touch or a support check or a potential entry location due to some anticipated reversal activity. And because of that, we tend to miss out, at least as new traders will tend to miss out on a lot of profitable opportunities that are out there. So one of the key points that I do want to get across just right off the bat is we want to look at support and resistance, or we like to look at support and resistance as an area, not an exact line. But as we move forward here, one of the reasons that, or some of the reasons that we care about support and resistance in and of itself provides us entry opportunities. And that in and of itself is what we're all looking for as traders. So accurately identifying these levels, the support and resistance levels, of course, means we have accurately identified which way the market will most likely head next. And as traders, everything we do revolves around making an accurate forecast. We are essentially the weathermen of the market. The better our forecast skills are, the more profitable we as traders can hope to be. Support and resistance provides us, take profit and stop loss targets as well. So it's not just about finding entry points. There's a lot of things that tell us to get into the market, But sometimes that's just, that's just a third of the battle, if you will. If finding the entry point is just, 1/3, the other portion is obviously going to be that stop loss, and finally is going to be that other 33%, if you will, is going to be the take profit level. These are all crucial. An improper take profit level can lead a proper entry into disaster, because maybe we set it at an unrealistic level, maybe we didn't pay attention to some other areas of support or resistance. So there's a lot more into it that we're going to see as we go forward. But moving along here. Conditions that contribute to the formation and or help find these levels. So previous price rejections or successful level tests, that's one. We have round numbers due to trader psychology, which we'll talk about further, of course. And then moving averages, as well as things like popular technical analysis tools like Fibonacci Retracement. All of these things arguably are probably the four most common reasons and or ways that traders are actively today finding these areas of support and resistance in the market. And it's one of those self-fulfilling prophecies. Support and resistance is in certain ways, because people expect the market to turn at a certain location. People then begin buying if they expect a strong area of support to present itself once we reach, said price. And if everybody starts buying because they're expecting that area of support to hold, because they're told that area is an area of support, because this tool is telling them that, or what, any of these reasons that we've already listed, people then buy, and then in turn, people buying then causes the market to rise, and it does have an effect on the market. So it's a very interesting thing, the way that technical analysis affects the market and just the way it works in general. I really like that word, or the phrase, the self-fulfilling prophecy, because in a way it is. And like I said, we'll get a little bit deeper into that when we get the charts on screen and we're kind of free-flowing with it. Now, the other thing that you might have heard when we were talking about the introduction here, we were talking about support and resistance, as well as something called closed data. That's a weird thing, and this might be something that you're a little bit less familiar with, because that's a term that I like to use myself, and it's possible that other people use it as well. But what I'm referencing when I say closed data, I'm referencing making trading decisions, or our assessments, or our forecasts that we were just talking about on candles or bar charts, whatever it is that we're looking at, based on data that is closed or as close to close. And that's your hint, because we're going to talk about that as we get into it as well. But as close to closed as possible. And there is a very important reason to this. Okay, so going on into this, what we have here is closed data is a term used to represent any closed out historical price data, which might be represented by candlesticks, bar charts, etc., as we were just discussing. A candle that is currently open or actively adjusting based on current price fluctuations would represent open data, or the opposite of closed data. And why we care? Why we care? Technical analysis traders entering the market after us take part in influencing the directional heading of price, as we were kind of talking about with that self-fulfilling prophecy idea. Their decisions, the traders, are based largely on the path that price has taken historically. I have a bit of a typo there, I apologize, up until their version of the present. This means if we execute based on the way something is currently looking before it has closed, there is a chance that it adjusts before closing and tells an entirely different story, leading to a different interpretation by all the traders entering after us, further influencing the potential discrepancy in our premature forecast. Now, that's a bunch of fancy words, if you will, to just describe sometimes it's better to wait. Sometimes it's better to wait, and most often, in my own experience at least, and I'm sure some of you can relate to this, sometimes when we jump in the gun because we see that a pin bar is forming or what have you, we jump in a little bit early because we're excited, because it looks like the beautiful setup if it were to close as a pin bar. And unfortunately, because we got a little too excited and jumped in early, unfortunately didn't close as a pin bar, and the resulting path that the market ends up taking thereafter is not indicative of what we would have expected should a pin bar came about. So that's more or less the summary or synopsis of what we're going to be talking about with the closed data. And I'm going to provide some ways that we can, some tricks that I use myself to execute on as close to closed data as possible. And it's pretty simple stuff. So nothing that we're going to be discussing today is going to be should be overly complex to understand. But once again, as Terry was talking about, if we have any and all questions, definitely feel free to get them in the chat box, and we'll do our best to make sure that we answer and clarify anything that is, comes up along the way. And I do believe that this is going to be recorded for everybody to be able to watch back at any point in time. So that is also good. So if you feel that I get going a little bit too fast because, maybe I get the jitters because of public speaking, I'm sure all of you, understand what that's like at times. So I might speak a little fast at times, and it might make you feel like, oh, hold on, slow down. But don't worry, you will be able to go back and play me on half speed if you need to at any point in time. But as we move along here, let's take a look at the charts and put this information into practice. Now comes the fun stuff. This is where we're going to just simply get away from these boring PowerPoints. I'm not here to just simply read to you. I'm instead here to represent what an active trader and somebody that's been trading. And to give you a little bit of a background on myself, just before we go too much further, I have been actively trading for a little bit over 15 years at this point. In regards to the years that I consider myself to have been a successful trader, if you will. All of us pay that learning tax in the beginning, but I've worked for a number of different firms, and at this point, I'm very proud to be, a representative of Earn2Trade and a mentor over there. And I feel I gain more from being able to take part in the success of others. I feel it's more rewarding to me than being able to just simply follow the information myself. So instead of just simply doing that, which I do trade myself as well, I like to share what I find in order to potentially help others save themselves from mistakes that I made early on as well. But that's a little bit about myself. But let's switch on over to the charts here, which shouldn't be too problematic. There we are. Our beautiful charts here we are. So at the moment, I'm currently displaying the ES. Those of you that know what the ES is, it's the E-mini S&P 500. So we're looking at some futures here. We're going to use this chart just specifically, which is current. Obviously, we're reaching the cash close as we're talking, but we're going to use the chart to potentially find some of these areas. We're going to talk about some locations where we might have potentially used some support to identify an entry location, and then we'll talk about how we can use some support and resistance as potential take profit locations, and also setting our stop loss as well. So let's go ahead and just dive off right on into it. And we'll start off. I'm trying to decide if I actually wanted to cover the closed data now, but first things first, we talked about the support and resistance first. So let's go ahead and dive right into that. We're going to talk about support because I see a beautiful level just right off the bat. And once again, this is today's data. So this isn't anything that I had, prepared weeks and weeks in advance. And that's because I don't feel that it's as authentic and as valuable to you if I give you just a picture perfect chart example that was pulled from 1997. So I don't know why we picked 1997, but if we take a look right here, folks, looks like we have a wonderful area of support. Now, forgive my sloppy drawing. That is supposed to be a perfectly straight horizontal line. And if I wanted to use my tools over here, I could just do that and give us a perfectly horizontal line. But I just didn't know if you guys would be able to see it okay. I'll try to highlight that. But right around this 2710 price point on the ES, we're looking at an example of support just right out of the gate. And let's just dive right on into it. So we already talked about that support's an area where we expect price to fall to and more or less run out of that selling pressure. The demand builds up, and we know that the market's just moving because of supply and demand. It's an area that the market has trouble falling through. It's an area that the market falls to, and then unfortunately for the sellers, find some strength, and then the buyers take control. Now this is illustrated by price coming down to this area, more or less stopping at this area, and then changing directions at this area. And the more times we see price come down, and this is a key point, folks, the more times we see price come down to an area of support and show a strong rejection off of it, the more comfortable us as traders generally view that level, or the more confident we generally become in that level. So as we can see, just this first level that was just pulled right off the get-go here, we can see that most recently, our last touch was right here. We had this wick where we came down, we kissed this level quite beautifully, pinged up off of it, and bounced up and away. And that led on to a bullish push leading up to the cash close. Now, that is a nice example of support, but we don't want just one. When we're identifying an area of support or resistance, we're generally looking for an area that has been an area that the market has, in terms of support, has bounced off of at least twice. We want an area that we can connect two lows, two swing lows that have bounced from the same or similar location at least twice. And the more closely we find that price has reached, or the more specific price has bounced from in regards to the price point that it has pivoted from, if that makes sense, folks, the more accurate we tend to view that level. And the easier it is to identify whether or not that level is holding and continuing to show confirmation, or whether or not it's broken. And as you're going throughout your trading career, you're going to notice that some levels tend to be a little bit sloppier, and they seem to be a bit of a wider area where the market is transitioning from that selling pressure to that buying pressure. So it's some levels are going to be a little bit wider, a little bit sloppier, so to speak, and then some levels are going to be a little bit tighter. We're going to notice prices rejecting within a spread of, maybe a point, maybe 2 points max. And those are areas that tend to be a lot easier for us to utilize. However, both of them are very valuable to us. So we have an area where we notice that price rejected recently. And as we keep going backwards, we're going to see a bunch of different times where price came down and kind of bounced up off of this level, as you see over here and here. We bounced off of that level a few times over there. We kind of came down to it, almost formed a bit of a double bottom there, and then found some strength, and up we went. And as we keep going backwards, we're notice another time where we kind of came down to this level. It bounced up off of it and kept on going. Now we had another bounce over here and another bounce over here. And you might be saying, Chris, what happened over here? What's going on there? Because obviously everywhere else in the market, we had these beautiful rejections, these beautiful examples of support, but not over here. This was a period in the market where we had a very hard sell-off, and this might be due to some fundamentals or what have you. There's any number of reasons that the market may have made a very sudden and sharp move at this point in time, and we're not going to break down that too much. The point is, the market did unfortunately slip just below our area of support that we would have already had marked off potentially just due to the support bounces that we see right here and here. And if we keep scrolling the charts backwards, I do believe that in the days past, we actually had some great examples of support being shown right around that 2710 as well, and or resistance. But we had an area where the market more or less slipped through. And here is an interesting fact about our support and resistance. It's very common that when we find these areas of support, when the market actually passes through this area, meaning it actually gets below it, we tend to notice that the area of support then can function as an area of resistance. So these levels aren't just valuable to us until they break and then we completely disregard them. And that's another common mistake that I tend to see new traders make. As soon as a strong level has been quote unquote broken, they go ahead and throw it out and say, oh, there's no further value to this. However, as you can see here, we had a crazy volatility window. We had a lot of volume send us straight through the level, but the market said, no. There's still a lot of buyers built up around this level, and we still had a whole lot of open interest in buying around this location, and they actually were able to suck price back above. But before they were able to, you'll notice that right here, if you can focus your eyes in, I know it's small and I do apologize, but we had a couple touches of our wick here where our wick actually went up to the underside of that support and actually got stuck for a moment. And then finally, all those buyers that kind of plateaued the market and said, we're not going to go a whole lot lower than right around that 2704 location, we more or less pushed our price right back above. And as soon as it did, we then saw another confirmation that this area was going to continue to function as a bit of a bouncy wall, a bit of a rubber band. That's an area that we notice the market just seems to have a strong aversion to, regardless of what side the market is on. So it's more important to me as a trader to be aware of support and resistance just as levels more. I prefer to use the term levels and areas more so than directly calling it an area of support or an area of resistance, because people tend to think that they're two completely different things. However, oftentimes an area of support becomes that area of resistance, and an area of resistance can become that future area of support. It's more important that I feel that I'm accurately able to identify these areas in the market where we're noticing these strong transitions from. And then what comes next, obviously, the quicker we're able to identify these strong areas of support and or resistance, the quicker we're able to profit off of them. If we know what the market is doing, all trading by technical analysis is nothing more than pattern recognition, folks. So if we're able to quickly realize what pattern is presenting itself and repeating itself in the market, the quicker we're going to be able to take advantage of that newfound information and probably make a very solid investment choice off of it. So if had I accurately identified this area of support over here when we had this nice beautiful bounce, 1 and 2, it's going to be hard for me to draw a 2 there. It looks more like a Z. I apologize. But we had two beautiful bounces over here. Then we came down, and if I wasn't interested in a long or wasn't already involved in a long that I was able to crush off of this level already, the part that would have really drove me nuts and would have really got me excited would have been when we fell through, came back above, and then showed support yet again. By this third time over here at this point, the fact that we were able to stabilize on top of this area of support after falling through with reckless abandon makes me like it even more. So at this point over here, this is what I'm going to be very, very interested in, some type of a long opportunity. So this area of support, this level, this proper recognition of support or resistance, being aware of this level in the market has now just potentially provided me an entry opportunity. And it's not just providing me an entry opportunity, it's providing me an entry direction. Because if we're closing on top of this area of support, and we know that the market wants to bounce when it reaches it, well, then I don't really need to think too much about which way the market's going, because obviously I'm expecting the market to go up if it is currently on top of it when it comes down near it. So ideally, a perfect scenario would be to get into the market for my buy at the closest location to this area of support while still remaining on top of it. That to me would be the ideal entry location. Now, that's our entry location. So that gives us a way in. So say right here, folks, we have ourselves in for a buy. We're looking in for that long. We're trying to take advantage of the market. Well, the next step is, as any responsible trader might be looking to do, we got to set ourselves some type of a stop loss location. We're not always going to be right. And that's just a fact of just the sad truth of trading. The market doesn't work in exacts. It works in percentages. Okay, and we don't need to win every trade. We don't need to be right 100% of the time to pull profit. A whole lot less than that. With proper money management, we can still continue to steadily climb. So what we want to do next is, instead of stressing about that, we have where we're going, we know which direction we're getting. Next step, we're going to go ahead and set ourselves a stop loss location. Well, setting our stop loss location is going to be pretty darn easy. If we have a reason to get into the trade because we expect price to be bouncing off of this area of support that we just were talking about, marking off somewhere near this X, if that's our logic for getting into the position, if that's the sole reason that we're entering the market, then where would it be representative? Ask yourself, where would it be representative of our information or our forecast being incorrect? Well, obviously, it would be at any point that the market moves below our area of support. So what I like to do is, if I'm in here for the long, I'm going to be looking to set my stop loss just outside. I'm going to be looking to set my stop loss just outside that area of support. Now, how far outside obviously is going to be a personal decision, because that's going to depend on how much profit you're looking to pull. It's going to depend on the risk to reward ratio that you're interested in maintaining. Obviously, that's a whole nother world. But the simple and the most important thing to understand is the concept of setting a stop loss just outside the point of interest, just outside this area of support. The logic behind our position. The logic behind our position says the price will bounce if it reaches support, which it has been doing. That means if it doesn't bounce and it comes down here, well, why do we need to continue to hold a position? Why do we need to sustain some ridiculous drawdown when instead when we can keep it very tight, very close, and if our forecast and what we're viewing on this area of support says it should bounce at support, then that means we don't need to have some crazy large stop loss outside that area of support, because as soon as it gets outside that area of support, well, then chances are it's not doing what we were expecting it to do, and we probably want to cut it out and move on to another position. Well, in this situation, it would have actually treated us quite well, and we had quite a few opportunities here for it to treat us quite well. But so in the scenario that we were talking about here, let me actually go ahead and erase some of this stuff here. Just bear with me 1 second. I want to make this a little bit cleaner to look at. All right, that'll do. That will do. Let's redraw that line. Okay, so the idea was we were looking for an entry location, and that's going to be marked off by the ellipse. So say we were looking to get into the market for a buy right around this location here. We would have set our stop loss, which I'm going to use a red line or a red rectangle. We'll use a red rectangle. How about that? Stop loss location would have been, anywhere around that box. Obviously, the closer to the support, the more likely the stop loss is to be hit, but the lower our risk. The farther from our entry location that we set our stop loss, obviously, the less likely it is that our stop loss will be hit, because it's giving it more room and to deal with any variance or any fluctuations. But unfortunately, it does come at a cost, and that cost is, if it is hit, then we have given away more, so we're risking more in that situation. But setting our stop loss somewhere in that box is going to give us a situation, and arguably, if you wanted to get a little bit safer with it, or a little bit looser with it, I should say, we could set it actually below this last recent swing low, but we're not going to jump too deep into that, because the idea that we're focused on is the strong level of support that was in play. But so we have a location where we'd be looking to set our stop loss. We have our direction, we have our trade entered. Now, what comes step number 3? Step number 3 for us is going to be looking for a take profit location. If we're looking for a take profit location, where are we going to go? Now, there's a couple ways that we can do this. Once the market starts working in our favor, we can either change our stop loss to break even. We can do that. We can leave it as is if we wanted to. Doesn't make a whole lot of sense at that point. But we can also go ahead and enter into a bit of a trailing stop. Okay, the reason why I'm talking about the trailing stop, those of you that are unfamiliar with a trailing stop, a quick summary of that is just simply a stop loss, a stop order that's going to follow the price by however, whatever distance that we set it to. It's going to continue to trail price. So say we have a 5-point stop loss or trailing stop. What's going to happen is every time the market moves higher, it's going to continuously benchmark 5 points behind the highest point that the market has achieved after our entry position. And what that's going to do is that's going to allow us to continuously ride the market. Say the market went on some crazy grindy spree and went up, say 50 points, and it just went up without ever having a drawdown of 5 points. Now that is a little bit unlikely, of course. But it is a beautiful scenario for those of us that do favor those trailing stops. It would allow us to capture in the momentum and the continuous rise of the market while also not worrying about our stop loss. And our stop loss is constantly benchmarking in and kind of locking in the forward progress and more or less locking in the profit that we're achieving without letting it possibly return to ground zero or possibly giving us a loss, so to speak. So that's the stop loss. So that's option 1 that we can take. There's kind of an A and B here. That's option 1 that we can take if we want to worry about that take profit location, because with the stop loss, obviously, we're not going to be too worried about setting a take profit location, because our goal is to just let that market ride instead of forecast where we're expecting it to pivot from at its highest point. But if the market is a little bit more volatile, it's not as grindy, it's not as trendy, we may not be in favor or may not be interested in using the trailing stop, because those are the market conditions that a trailing stop tends to do best in. Those consistent, slow, constantly grindy, trendy markets that aren't so swingy. The days that look like roller coasters, those aren't usually the days that we enjoy using those trailing stops so much. But what we're looking at here is option number 2 would be to set a hard take profit level. So we use the support level to identify the entry position and the directional heading, and we also use the support level to properly identify where we want to set our stop loss location. The next thing is to say, where do we want to set our take profit location? And this is where the knowledge and practice of identifying support and resistance can come in again. Now, obviously, there's a lot of ways to forecast when the market is, or the locations that the market might get stuck at or might pivot from, or those areas where the supply might outweigh the demand and we might see price start falling again. But just simply, if all we know is support and resistance, we can still properly set ourselves a beautiful take profit location just by paying attention to previous areas of support and resistance. Just like we expect the market to bounce off of this level because we identified it as an area of support, we can also expect the market to reject from an area of resistance. So if we go to the market and we look to the left and we look to the right and we say, okay, let's go ahead and see if we can find ourselves an area where we notice resistance. Well, right off the bat, it looks like we noticed some resistance right up here. Actually, let's switch that over to the horizontal line. Oh no, I erased them. Oh well, we'll survive. So if we set ourselves a line up here, we have ourselves a line down here that's already marked off. Let's say we notice a little bit more resistance or a little bit weird level activity around this location here as well. Okay, so we have 2 locations in the market. There we are. So we have 2 locations in the market where, once again, this represents the support level that we have found. Then this represents another area in the market, another level in the market, if you will, and determined as support or resistance is only going to be, the word support or resistance is only going to matter in regards to where price is currently located in relation to that level. So I am going to just refer to it as, once again, a level. So at this point, we're going to go ahead and mark off another level up here. Now we have 3 clearly identifiable levels on the chart. So setting our take profit location is going to be as easy as saying, okay, this is our next major area where we might be encountering some type of resistance. So where would you think it would make sense? If we expect price to reject and go down when it reaches this location, just drawn a big arrow there. It's a big ugly arrow. So we've got an expectation that price is going to reject when it reaches this line. Well, it probably makes sense to be setting our take profit location just underneath that level for some type of an easy scalp. Now, once again, this is currently being done, or everything I'm doing right now is being done on a 15-minute ES chart. So we're looking at short-term charts here. However, one of the beautiful things about understanding what I'm talking about is support and resistance can be used on any market, on any asset, in any time frame. We can use this logic, we can use this information to pull extremely strong trades and highly profitable trades on any time frame. So we can do this on the dailies. It doesn't matter, folks. We can do this on any time frame. It doesn't matter. So we can scale up, we can scale down, we can scale all around town. The idea is to understand the concept behind what we're talking about and what these areas look like and how to identify these areas. And then, once again, how to use these areas. So a little bit of an aside there, but we identified with our red box down here in the bottom that we'd be looking to set a take profit location somewhere down here like this. Okay, so we'd be looking to set a take profit location somewhere around here. We can identify that red box as our risk, meaning the bottom of that location represents our, our actual stop loss itself. We can represent our entry location with, we'll do the ellipse here, and we'll go green. So there's our entry location. And then obviously our take profit location, we'll use a rectangle here and draw the area that we expect to logically gain from this position. And you're going to immediately notice a very solid risk to reward ratio. You don't have to count the numbers on the side of your screen. You don't have to have Superman eyes to be able to see that we're looking at a pretty good risk to reward ratio here, far better than 2 to 1 already. Okay, and obviously, if we wanted to, we could scale that stop loss a little bit farther if we wanted to be a little bit looser with us, but give a little bit more leeway room with the position. We can also tighten down the take profit if we want to. But the reason why I drew my take profit location, my green box here, is to the point that I did. You'll notice that as we go to the right and the left here, you'll notice that this is an area in the market that is a little bit away from my anticipated area of resistance. So we know that next white line up here is an anticipated area of resistance. We know that that's an area in the market that might cause our position some trouble and could change some of that bullish pressure and cause that bullish pressure to become some bearish pressure. And, you know, at that point in time, we ideally would like to be out of our long position if we're anticipating the market to fall, because that would represent in and of itself an entirely new position potential. As we reach resistance, we can then open ourselves up some beautiful short opportunities in anticipation of that market to fall. But the idea is one trade at a time. We looked in for our long, we got in the circle, or could have potentially gotten in the circle, of course, and we identified where we wanted our stop loss location. And then we were able to identify, by just paying attention to other areas of support and resistance, other levels in the market, we were able to identify a logical position. And that's the key word here. I could set my, you know, it's real easy for somebody to, you know, say, oh, well, Chris, I'm going to go for a 100-to-1 risk to reward trade here. I'm going to go for something where I'm looking to, I'm going to gain, you know, 10,000 points on my position. Sure, you can set your take profit 10,000 points high, but come on, folks, is it realistic that it's going to get there? No. Okay, having our take profit location set too high can be just as dangerous to having our stop loss location set too low. We don't want to give the market chances to take back our, you know, or to ruin our proper forecast. The idea is to take what's reasonable, to take what the market is currently offering us, and to roll and flow with the market, just like we were surfing a wave or anything else that you might be able to relate to in your life. The idea is just to go with the ebbs and the flows of the market. And with the way the market was currently acting today, this is an absolutely reasonable take profit location. And without really a whole lot of reason for us to expect at this point in time, at the time the position was executed, with the information that we have on the screen, it was very, very reasonable to expect that price might reach this area without, you know, without a whole lot of difficulty. The first difficult area would have represented that white line, and to be safe, what we did was we would have marked off our take profit location somewhere underneath that line, giving us some space just in case we rejected a little bit early. The tighter we are, you know, the more we might drop that location down. The looser we are and the more aggressive we want to be, the closer to that white line that we might set our take profit location. So we've given ourselves a very solid position opportunity. And if we were to look at this position and we were to say, okay, well, you know, you're just rolling with it, Chris, how would it have turned out for us? Because initially it looks like it was well on its way there, but unfortunately kind of stalemated here. We kind of plateaued, and then we actually came back down. But look what happened over here. Support kicked in, support held, and up we went. And the end result would have been a situation in which this trade would have actually turned out profitable. And I didn't use this example, once again, this wasn't a pre-planned example. It's not something that I would have used here just because it worked. I would love to show you guys some examples where it doesn't work as well, and well, it's just going to be market willing. But the idea is, with proper recognition of these levels, the support and resistance trading, we can very easily find ourselves some positions in the market that are going to win us more than they're going to lose us. And that's just in regards to the accuracy of it in general. And that's not even regarding the proper money management that can further excel what we're talking about, that can further, you know, advance the profit that we're pulling out of the market. Because in the beginning, I was talking that we don't need to win 100% of our trades to maintain being profitable. In theory, we could actually lose more trades by the numbers than we're winning and actually maintain building profit. But the idea that I'm trying to get across, with proper understanding of support and resistance, there should be no reason, even just by the pure accuracy numbers, that is even remotely a thing. Just with a strong understanding of support and resistance, I would strongly expect that traders should be pulling some type of above, substantially above, hopefully, level of accuracy. Now, here's the thing. You might say, well, Chris, I've traded with support and resistance before, or kind of experimented with it, read a little bit about it. It didn't really know what I was doing, and I didn't really get the greatest results out of it. And that, in and of itself, is going to be something that you'll find in your trading careers, and I think a lot of you can attest to this. It's going to be one of those things that is going to require a little bit of experience. It's a little bit of finesse. I've been doing this for maybe longer than you, maybe shorter than you. Maybe some of you in attendance have been trading for 20 plus years and you've got me beat in terms of that regards. And maybe you're actually a little bit better than this. It's totally possible. I'll never claim to be the best trader alive, but I can claim to feel very comfortable in my understanding of support and resistance. And I'm always very excited to share this type of information with traders, because I find all too often we see traders constantly using indicators or looking for the holy grail. They're looking for an indicator that is going to do everything for them. It's going to put an arrow on their charts, and it's going to tell them, I want you in here, and you're going to get in here. And at the end of the day, what ends up happening is these traders blindly follow these indicators, have no idea why they're following the indicator. They're just doing as they're told. They become a mindless zombie, and then when it fails, they have absolutely no idea why. And that's because they aren't paying attention to the core fundamentals of what's going on behind the technical analysis that's actually driving the market. We don't need all of that stuff. We don't need all of that stuff. Do we really think, folks, that the best traders in the world are using an indicator that's being advertised on some side window on a website? Come on now. Support and resistance and the core principles of technical analysis can give us everything we need without overcomplicating everything and without having to give any unnecessary, money away, just by educating ourselves, just by understanding what it is that we're looking at in the market, why it's going to where it is, and understanding those core principles behind the supply and demand, because that is what's driving the market. And if I got a little hyped up there, I am sorry, folks. I've just seen entirely one too many people being taken advantage of and actually becoming their own worst enemies and looking a lot harder at trading than they need to. But that is a great example we were just talking about of how to find, at this point, what we've covered is we've covered how to find an area of support and resistance, how to find these levels in the market, and how we might go about executing an order, as well as a take profit location and a stop loss location off of it. In order to do resistance, it would completely be the exact inverse of everything I said. Everything would be more or less the same. The just direction of the trade would just be the opposite. If we were to reverse all of this around and we were looking for an area of resistance, we'd find an area of resistance, and obviously we would set our stop loss location just above that area of resistance in question. We would set our take profit location somewhere just above the next support level, because remember, guys, the market would be falling if we're in for that short, if we're in for that sell based off of that resistance. And obviously, the same, logic of identifying these levels would come into play. We'll see if we could actually scroll the charts back and find some good examples here. We had a little bit of resistance being shown on the market today around a few different locations here. Here we had some resistance being shown, but then the market immediately blew through it. And remember, we find try and kind of apply or view an area, a level in the market stronger or weaker based on how many times we've seen a clean rejection, how many times prices reached that location and reversed and gone back the other way, kind of with its tail running. So this level in the market that we have marked off here obviously isn't nearly as beautiful as this area of support. And one more thing that I would like to stress as well, while we're support and resistance trading, of course, it is theoretically possible and absolutely doable, and traders do it every day, to trade both longs and shorts throughout the day, regardless of the overall trend. Meaning if we're looking at a bullish trend, it's more or less what we were dealing with today. If we're looking at some bullish activity in the market, yes, we can still pull off some profitable shorts based on identifying those areas of resistance. However, I will be the first to tell you, based on my own personal experience, and I'm sure you've heard this before, the trend is your friend, folks. We don't need to overcomplicate anything. The KISS method is one of my favorite methods. Keep it simple, stupid. We like to stay with the trend. We like to keep the trend as our friend. We like to pay attention to clean chart data, see what's actually happening in the market. We don't need to overcomplicate anything. And the market, more often than not, will tell us what it's trying to do. Half the time, we're just not willing to listen. So we got ourselves a nice example of the buy. Let's see what else I can find for you. So we have an example of some resistance being shown in the market where we found some resistance and it kind of immediately went through. And then it wasn't until over here that it showed resistance yet again. And then over here, when it finally did break through, we then began functioning some support around this location quite a lot, actually. So the market was much more in favor of support today than resistance. But that's another example of one of those areas being both. It's an area where we found resistance and that became an area of support, and vice versa. versa, just depending on which location the market was on. We can view these areas of support as more or less, and resistance, more or less areas in the market where it just doesn't want to be, really. We can think of, putting the north side of two north ends of a magnet together, and that strong aversion where they're just pushing away. That's just how the market acts. Sure, we could flip them around and it can get through, and then all of a sudden that support has become resistance. But the idea is when it gets to that level, more often than not, we're going to see it reject and go back whatever way it was coming from. Doesn't mean it's going to do it 100% of the time, but it is more likely than not going to do it. And obviously, the skill's going to come. The more accurately we're able to identify these areas, the better we are with identifying an area and dictating how strong it is, the better off we're going to be at, pulling out these profitable trades. And there is a skill set involved with it. And I by no means want to make this seem overly easy, but I also want you to understand that it is absolutely doable. It is absolutely doable with any actual perseverance and some screen time. I firmly believe that I could teach anybody support and resistance trading to a profitable degree. So that is one of the reasons I'm such a big fan of it. Now, the next subject that we were talking about or had in the headline of the presentation today was the importance of trading on closed data. And that's a bit of a weird term for some of you, but trading on closed data, that's the whole idea of letting the market be as close to solidified for all of time, so to speak, as possible before we make our judgment, before we make our decision to get in for that buy, to get in for that sell. And there's a few ways that we can do that. We talked about in the beginning, I just briefly gave an example of how if we were trading the market. Let's go ahead and erase this stuff off screen because I'm going to use some other, I want to mark off some other areas here. So if we look over here, for example, right here, let's actually put an arrow there. All right, that works. Hopefully that works. We have an area where we noticed this market kind of gave us a weird little bit of a bit of an inversion formation here. We found some rejection at the top, but let's pretend just for a moment. That we were watching price travel upwards. Let's pretend for a moment that this area that we have marked off as potential resistance that became resistance again. Let's pretend that we didn't know that, and we were anticipating the market to more or less just keep on going. And let's say that this was showing a new high. We're just kind of working our way up here. We had this big powerful green candle here, blue in regards to my charts. But so let's say that the current candle was looking like that at some point or another, which at some point it was looking like that, and that can be displayed because we know that because we look at the wick. Obviously, the wick tells us where price was, just not where price closed. The body tells us where price closed. Now, if we were to say, okay, this is a very strong bullish sign, the candle is looking like a powerful bull. We're sitting here, big, strong bodied candle hitting new highs, potentially smashing through resistance. So why not looking for the buy in anticipation for the market to rise? Now, just bear with me, folks, once again. So had we jumped in for the buy, we would have been unpleasantly surprised when the market actually closed off as what it was, what was it? It was, boop, there it is, a pretty bearish candle, a pretty indicative sign that the market is actually running into that resistance and looking to fall, which it then did. But had we jumped in while it was green, which at one point, this candle that we're talking about was actually a powerful bullish looking candle, possibly indicating had it closed that way just by price action in that Japanese candlestick analysis, it would have been indicative of expecting the market to rise. Well, had we got in for that rise, or got in with the expectation the market to rise for that long, we wouldn't have been very happy with the results. Now, had we waited for the candle to close, or as close to close as possible, we would have viewed that entire situation completely differently, and we would not have gotten ourselves involved in a situation we could have avoided a potential mistake. So being patient as a trader is a very important virtue. And what I like to do myself, I personally like to execute into my positions as close to close data as possible. That means I don't like to execute while a new candle is in formation. That doesn't mean I won't, but I like to execute on the closest possible time frame to the close of that candle that I can do, that I can possibly muster up. And my logic behind that, now this is a little bit more of a personal preference, but it's something I've found great success in, so I want to share it. So the idea is, if I'm looking at a 15-minute candle and that candle has, say, 30 seconds or so left in it, it doesn't have a whole lot of time left in it, and it's sitting as, say, a strong bullish candle at that point, well, then I may get myself my position ready in anticipation of that buy that I might be looking to take, because at that point, with 30 seconds left in the candle, it's not really likely. Now, is it possible? Absolutely, but it's not likely that we're going to see the market transition from that bullish state to some ridiculously bearish state. Whereas, had we jumped in, say, once again, looking at 15-minute bars, had we jumped in during the first 1 minute of the candle's formation, while it was looking at, say, it was looking like a pin bar, so we got in anticipation of a pin bar's result, and we got in anticipation of some type of reversal to happen, with the first 1 minute, with 14 minutes of data still to be drawn, and that candle still moving all abouts and all around, the end result could be very, very different. We could give ourselves a false read. We could get in for a false position, and that's something I see a lot of new traders do, and that's why I wanted to bring that one to you guys as well. It's very important to understand that there's no rush when it comes to trading. And if we ever find ourselves in a rush, then chances are we probably shouldn't be trading at that point in time. It is to do everything intelligently. And a lot of times we know the correct answer before we do it. And then we end up saying afterwards, oh, why did I do that? I knew better than that. Let's be proud of ourselves and let's say, okay, we're aware that the market's doing this. We're going to be patient. We know that's the correct answer to do. We don't want to be duped. And we're going to trade as close to closed data as possible. And you'll be amazed at the results that you might find with that. Now, maybe that's not your style of trading, and it doesn't have to be. But once again, it's something that I have found has helped my own personal trading, and it's something that I found over the years that helped give me a further advantage over the market. It helped increase my equity in the market just by doing something as simple as that. It doesn't have to be groundbreaking technology or a groundbreaking strategy or something ridiculously complicated to be correct, or to be helpful to us as a trader. And that's just something I want to share. So once again, trading as close to the close of data as possible is something that, once again, I strongly encourage or challenge you to try out yourself and see how it affects your trading. See if it causes you. I strongly anticipate that you're going to find yourself in a situation where you notice that you might have otherwise jumped in on the position, but all of a sudden, because you were waiting, because you were saying, oh, let's see what this crazy guy Chris said, and actually try to, I'm just going to test it out, you might find yourself that you just saved yourself a very costly position just by being patient and just by trying to get in right before the close, while it's as close to closed as possible, while you're not being influenced by a new candle being open. And that's the other reason that I don't like to trade. So you could say, Chris, well, why don't we just let that candle close and then only focus on that candle? Yes, that is also possible. Absolutely, sure is. But the problem is, the idea of us as traders is we want to take, technical analysis traders anyways, we want to take all of the information present up until that very second, and we want to use as much information as physically available to us to justify our position. So as close to the close as possible, I feel, is the highest point of information available to us, with the highest likelihood that the candle is still going to be closing as it's currently being displayed. So that's the logic behind that. But at this point, I think I spent a little bit of time there diving into the support and a little bit more so into the support than the resistance. But I feel that we, just with a simple reversal of everything I said in regards to the support, I think that you guys will, find that the resistance is pretty easy to understand as well. And it's the idea of identifying a level. And something else that I didn't jump onto that I want to make sure I do before we jump into the question and answers, which I imagine are obviously coming soon, we're looking at these areas, once again, as a location zone. versus an exact price. And that can help tremendously with those of us that are trying to increase our skill and efficiency with drawing these support and resistance lines. Some people will say, okay, if we're looking at the market as it sits right now, and we say, okay, let's switch on over to our line, shall we? All right, beautiful. So we're looking at this area of support that we were talking about in question. You'll notice that there's a couple times where it actually, kind of fell here. This time it was just a bit above, obviously over here we had some interesting activity. Here we kind of touched it here, and here. So the idea behind this, what we're currently looking at, is I'm going to draw my line if I'm just going to use a line and not a shaded area, which sometimes I do that as well. I'll use a shaded rectangle to identify a support or resistance, or a level zone, I should say. The idea is the zone that we're drawing should encompass the most touches. Okay, so that line should be drawn and crossing through the most locations that the market has touched and rejected from. That's where we're going to do it. We're not just going to do it, or I'm personally not going to be doing it at the lowest location that any wick has ever reached. I'm not going to be doing it at, at the highest location any price has ever reached. I'm going to try to find that perfect average, the area where the market has rejected from the location around which point the market has reasonably rejected from the most. That is a valuable piece of information for those of you that are finding a little bit of difficulty in identifying these levels as you're trading throughout the market throughout the day. And there's a lot of different ways that we can also identify other big powerful levels as too. And we could be talking about this. I could go on about this all day, but such as switching the time frames. If I wanted to switch my time frames from 15 minutes to say hourly, I can identify and mark off some higher time frame areas of support or resistance, and then I can back down to that shorter time frame, and then I can go ahead and pay attention to those levels throughout the day as we're trading. And if I'm on the shorter time frame, on that 15-minute, and I'm approaching a line that I drew from a daily chart or from an hourly chart, if it's from a higher time frame, I'm going to give it a little bit more weight, and I'm going to expect some more activity from it, generally speaking. So that is something else there. But why don't we jump at this point? I feel like we're in a pretty good location. Terry, if you want to jump on into the questions and the answers if we have them.
Okay, give me 1 second. If you use fib retracements, do you use fib zones?
I might be talking to myself at the moment. Well, of course not to myself, because all of you wonderful people are here, and I do want to answer some of your questions, and I was hoping to jump onto that. But regardless, I'm not afraid to keep diving into the subject. Of course, I'm not afraid to keep moving on and finding some more support and resistance. Should we need to? Hopefully my audio and everything is still coming through, but it doesn't look like I have access at the moment from on my side some of the questions that I was hoping to see, or potentially everybody just feels solid in their understanding in that regard. But if everyone will just bear with me at the moment as we see if we can get some of those questions pulled up here.
It looks like Chris is not able to hear me.
I might be having some sound issues on my end, folks. 1 second. I feel like that could be the issue there.
Hey,
Terry, if you could. Oh, there we go. Okay, I apologize, guys. I just goofed myself. If you ever goofed, it happened to me. It looks like during that all that speaking I was going on, my wireless headset actually turned itself off. So I apologize if you were talking. I couldn't hear it. So.
If you use fib retracements, do you use fib zones?
Fibonacci Retracement, another beautiful tool. We actually had that, I think, in our initial, I think in my initial PowerPoint, I mentioned Fibonacci retracements. But yes, Fibonacci retracement, a lot of times we find beautiful support and resistance levels around that 61.8% retracement zone. That's often referred to as the golden zone. That is one of my favorites. That and the 38.2, you'll find a lot of people. I also prefer the 50, but 38.2 and 61.8 tend to be some beautiful formation zones for these levels that we're talking about, if that answers your question.
Okay. Since you can only see a limited time period on a 5-minute chart, does it make sense to draw support and resistance from higher time frames, say a 60-minute chart, etc.?
Absolutely. Absolutely. And that was something that I was talking about a little bit ago. Hopefully my sound issues didn't translate to any issues with anyone hearing me either. But yeah, I feel that when we look at a 5-minute chart, whether it be 5, 15, what have you, if that's our home chart, that's the chart that we feel that we're making most of our trades based on, I still like to, at the beginning of my trading session, I still like to switch out to at least a few average time frames, if you will, out. Obviously, every chart, the time interval change might be different. But if I'm on a 5-minute chart, you better believe I'm going to be jumping out to the 30-minute chart, taking a peek at that. I'm also going to jump out to maybe an hourly or a 4-hour chart and also take a peek at that. It allows me to get a good idea of where that overall trend is heading, and also to mark off some of those higher time frame levels, which tend to be a little bit more reliable, even on the shorter time frame as well. So that's a very good question and a very good suggestion.
Okay. I think that is the last of the questions I'm seeing. There was a question on the on trading the closed candles, but you went right into that before the question, so that was good. Okay, we're at the hour mark anyway, and I think that's it for the questions. So thank you for the webinar, for the information, and for spending some time with us this evening, Chris.
Yeah, thank you for having me. I appreciate it. I enjoyed that.